Okay, well, as I believe Dan was talking about, I got my start in trading from starting my own website way back in the day. Online trading was kind of in its infancy back then. And, he mentioned that one of the best things that you can do for your own trading is to help teach other traders. And I first got into teaching other traders by posting a lot of my trades that I was following at my first site, which was swingtrader.net. And from there, I got quite a following. Was invited to do newsletter, which stemmed into a chat room and kind of went from there. And, I don't know if I hadn't started teaching other traders, if I'd still be around today. And the reason for that is that when you're looking at trying to explain what you are doing and explaining it to someone else, it really makes you think through your process. And from that day forward, I've continued to educate other traders and continue to learn at the same time. I'm always learning, 20 plus years in this industry, and I'm still learning today. And today I want to share with you and teach you guys a little bit about the market that you might not have known before, or from a different viewpoint that you might not have seen before. I give a lot of my classes where I'm giving the same topics over and over again, but with each class I'm speaking from a little bit of a different standpoint, explaining things a little bit differently, and that's one art of teaching and explaining the markets to someone, where it helps really kind of solidify it in your own thinking as well. And what I like to do is that when I'm teaching a class, for example, this one is maximizing gains using momentum-based Fibonacci. I use things that have happened over time. So you're going to be seeing examples of trades that I've taken years ago, as well as those that I took as early as less than 24 hours ago in today's session. So you're going to see and understand that my strategies, my technique, my mindset, my methodology, this is all something that has developed over time but remains just as valid today as it did 20 years ago. And it's going to remain just as valid tomorrow as well. So without further ado, let's get going here and dive into what you're going to learn today. So in this class, we're going to talk about what momentum means in a security and the important role that it plays in determining a security's fate. We're going to look at how to correctly utilize Fibonacci extension levels to identify targets, and the key word there is correctly. And you're going to see what I mean here very, very shortly. And we're also going to look at how you can manage positions and adjust targets as a trade unfolds by using these techniques. So the very first thing we have to begin with is the basics, and that is understanding momentum and what momentum means in a security. Now, you might be a stock trader, futures trader, options trader, forex trader, gold trader, bond trader. I don't care. If you can't understand momentum, you're not going to be able to read pure price action in the market. And without reading pure price action in the market, you're going to miss a lot. So when we talk about momentum, what I'm looking at is how prices change and shift over time. You can use a line chart, you can use candlestick charts, it doesn't matter. What we're looking at is the primary price action in a trend. So a trend is obviously the main direction that any security is moving at a given time. When you look at any chart, you're going to notice that there are really sharp moves, and then there are more gradual periods of congestion and more gradual, slower, corrective type of moves. These initial moves are called impulse moves, and they happen on all time frames, all charts, all time frames. I'll show you them on some charts here in just a minute. And then we have the secondary moves, and these tend to be the corrective type of moves. So when we have an impulse move where momentum is pretty normal on the upside, and by normal, what we're using as a judgment clue for what is normal is when you see back and forth moves on any security where they're represented by like V's or inverted V's, Those are what I would consider typical impulse moves in a security. And those are going to be what we're going to use to measure all subsequent moves that happen within that security. So when we have an impulse move in a security, the most typical way that an impulse move will correct will be through a more gradual counter move, such as 1. And when a move is substantially slower than average, you have a really strong chance of getting a nice solid breakout strategy. Now, as the trend continues, you'll often see momentum begin to shift. For example, wave 3 on the upside here, we still had the same momentum on this impulse move on the upside, but now we started to see a shift. The correction is stronger as the trend has become more extended. The larger trend, we're beginning to see trend exhaustion slip in. I'm not going to get too much into trends development today, but when we look at anything in the market, trends, momentums, time development, they all work together to form a larger picture. So when we're looking at these momentum shifts, they give us a clue for what can happen next in a trend. So when a momentum begins to change and we start to see it increase and the speed increase going another direction, that can give us a clue for what can happen next, where we can see slowing compared to previous impulse moves. This can lead to strategies like a 2T or a double top. Maybe you get a slightly higher high, creates a trap. That can lead to an even better shift in momentum where you can get a stronger downside move. Momentum can further begin to shift, where you will have a slowdown because now we have stronger than average momentum on the downside. That is often followed by slower momentum, and so on and so forth. And it's often subtle shifts in momentum that can change and drive the market over time. So usually when I'm looking at a security, I will have an idea of not only what the next most likely moves are going to be on that security, usually narrowed down to 3 possibilities, but I'll also have a really good idea of what the moves are going to be that will follow that next move. So for example, something like this. You will usually have this fall into longer trading range like that. You'll see it go and possibly hit a slightly higher high like that in reverse. These are just a couple of the options that can unfold following this type of trend development. Now, let's look at this going a little bit further. When we look at those V's again and get back into the V directions, you can see these V patterns back and forth where you have pretty strong momentum both ways, but the overall channel will begin to shift compared to previous action. So all trends will have, back and forth moves within them, but as the channel shifts, it will indicate a shift in momentum as well. And that will start to indicate what will be coming up and what can happen following that. So for example, when you have a strong momentum move up to the upside like this, and it holds that pivot high, falls into a trading range, well then you have a better chance of a really solid upside breakout a little bit later on. When momentum shifts though, like what we see here, where it rounds off at highs, then that slowdown, even though the overall upside moves might still be strong or stronger than average even, the overall change in momentum allows it to turn around, can change, and actually reverse the trend. This is where you get things like your inverse cup with handle and other reversal strategies that can come following this. When we look at how to measure a trend, I look at transecting the trend as a whole to give me a good idea of where that trend is really standing. If you look at just the small back and forth moves within a trend, you might think, okay, you know what, that's still showing me a lot of strength. And to some extent that's true. But at another level, when you look at connecting highs within a channel, and the lows within a channel, that can paint a little bit of a different picture. Meaning it can show you that your momentum is actually starting to shift compared to previous moves in the security. So you can actually see things starting to roll over even when these shorter impulse moves might still be just as strong as previous impulse moves. Even further, you can get these triangles form where the back and forth movements are still showing pretty strong impulse moves on the shorter time frames. But when, again, you look at the trend channel as a whole, we're actually dealing with a sideways trading channel now, as opposed to a strong uptrend or even a more gradual uptrend like we saw back here. You'll see here in a minute why this becomes so important. When we're looking at momentum and using it to identify target levels and places where we want to take our gains, and even for managing a position once we are already in something, the momentum plays a very, very crucial role. So when you have a momentum move coming out of a strategy like a correction where, let's say, you've got a pullback, 50% pullback, or you've got a bull flag, you might have a phoenix. A phoenix is just, basically it's just that first continuation. So you have a little tiny phoenix right here, for example. So first continuation that kicks off a new trend. In all of these, when you have a more gradual pullback following a stronger move to the upside, then you have a really good chance of getting a breakout strategy that's going to try to give you an equal or measured move as compared to that initial impulse move that took place before the pullback. Now, what is a typical measurement for an impulse move? One way you can get the good feel for that is to look back in time and look for periods of where you see V's or inverse V's taking place in the security, because each side of that V is going to give you what an average momentum move is for that security. Don't rely on things like a 45-degree angle, any sort of angle really, to try to give you a judgment call, because as you change your scaling on your charts, that's going to change what those, the angle of each of those is going to be. So look back over time, look for periods where you have these mountains and these valleys, and use that as your judgment call for what an average momentum move is in that security. Now, as long as the momentum that breaks out of a correction is comparable to the momentum that took place prior to that correction, the target level is typically going to be 100% equal or measured move. And usually it's going to hit that pretty easily, as long as the trend is not too extended. There's going to be exceptions where you're dealing with trend exhaustion where it will struggle. For example, those of you that know Elliott Wave or have taken any of my other courses before, you'll know that a typical trend consists of 2 or 3 waves. And then you'll usually see a correction following that. Now, if you get, for example, an attempt at a 4th wave, then it will have a harder time hitting that equal measured move, even if it offers a continuation strategy in that same direction. So trend development is going to go hand in hand with understanding momentum and understanding target levels. We just don't have time to get into that in a lot of detail today. So, join me for some of my other classes and you learn a lot more about trend development. I want to show you guys something actually. Speaking of other classes, I have a boot camp underway right now. It's a market timing boot camp. And we were looking at a trade here on Tesla last week. And Tesla was an avalanche, which is the inverse of Phoenix. And it's basically the first continuation of what can kick off a new downtrend. Now, in this scenario, we were also looking at it within the context of a head and shoulders. Here's your shoulder. Here's your head, here's your right shoulder, and in the larger context, it was a 2T. A 2T is a reversal strategy where you have a high and then you have a slightly higher high that creates a trap. So all of these are working in favor for a continuation strategy on the downside last week. Now, when we looked at Tesla in this boot camp that I'm teaching, one of the things we looked at was how to identify a target level on it. You know, what sort of potential would Tesla have on the daily time frame? And of course, you can see very quickly that the momentum on Tesla, as it was breaking down out of this period of congestion, was very comparable to what that momentum was going into that congestion. That meant that a typical target level would be the 100% extension of this move. Now, when we look at how to draw that on the chart, this is where things can get a little bit tricky. And I'm actually going to go over to the chart itself. So here is Tesla on TradeStation. And I want to show you guys how I drew this. So I'm using this tool over here where we are looking at, usually it shows you these names here. So here's the retracement, here's the extension, and it's basically a 3-point tool. And when we're looking at periods of congestion, one of the mistakes a lot of traders make is they will go from absolute highs to absolute lows even when momentum is shifting and showing that a correction is already under play. So when we look at Tesla, for example, we have an initial move here that brings it into a level of support right here. And you can see this with the momentum shifting. This is actually a momentum reversal strategy that ended up developing, which is a reversal type of trade. And when I'm drawing these extension levels, what I'm looking for is that first impulse move. And then I'm treating this as part of this larger correction that is taking place. The same thing would happen if you were dealing with a 2B or a 2T here, for example. So instead of drawing like going from a low to a high right here, which is slightly higher than this high, I would go from a low down here to a high up here and use this as part of my continuation for my congestion or the correction. So here we're taking a beginner type of strategy and we're making it a little bit more advanced. Now, you'll notice that this goes and hits that 100% level almost exactly because the momentum is right at that same type of move that we saw going into this congestion. Now, even if you did this a little bit differently, and let's say you did use the absolute low, a lot of times that will still correlate with some sort of Fibonacci support. So in this example, it's that 76.4% level. But the problem that you run into with this is that over time, you're not addressing the fact that this is still where this correction really began. It began with a slowdown and a correction through time rather than price. Corrections through time can mean a base or it can mean some slightly lower lows. So this is a totally different way than most people will look at applying these Fibonacci levels. But it's a really important way when trying to understand why your target levels might not hit sometimes and why they may otherwise, because you're probably drawing your extension levels based upon the absolute high and the absolute low as opposed to where you're starting to see the momentum shifting. So the same thing over here. I go from the high and the low, not where that momentum really, where we had a subsequent high a little bit later on, because this entire zone here is correcting and congesting. So, going back to that trade there, This is an example here from a really recent one, and this is in that market timing bootcamp that I have going on right now, and I'll give you guys more information on that because it is not too late to join us in that market timing bootcamp. I know a lot of you guys in here today right now are in that, so this is just some extra education here for you guys today. We're going to flip back to the PowerPoint that I have. And again, here is that continuation that we saw here into this week. And we're also going to now look at momentum as it can exceed expectations as well. So when we have momentum increasing coming out of a period congestion, here we have a little two-wave pullback, two-wave correction in here, and momentum is actually picking up coming off of this. This can happen a lot when things are starting to kind of round off at lows. If this is a longer downtrend over here, for example, then you'll see this sort of things start to happen. It can also continue to ramp up where, the third time around you might see an even sharper move to the upside. So usually if the second wave is stronger and you have a three-wave trend, the third wave will be even stronger still. So when we're looking at momentum where the momentum is stronger, then we're usually going to be looking at a target level that is going to go further than that equal or measured move. So here is an example from last week in ADSK, Autodesk, where it had a really nice solid trading channel following a nice two-wave move to the upside. And as this broke out, initially it wasn't looking too favorable for an upside breakout. Things were a little bit sloppy in here. But within this action, we actually had that momentum type of reversal with these three evenly spaced lows, kind of helped shift momentum a little bit. And it continued to shift here on the 19th with that Phoenix intraday. When it broke out, it gained momentum. It had a really strong, sharp breakout then compared to the momentum that we saw going into that trading channel. And that momentum continued with a gap into the next trading day. So very quickly, this was able to test that 100% equal measured move level, and it was able to push through that level. A lot of times when a security pushes through the 100% level because momentum is gaining speed compared to the impulse action going into a zone of congestion or correction, a lot of times that 100% level can still serve as a level where it will start to slow momentum. So you'll get a continuation of the trend, but the momentum will begin to shift at that point. So it's still a good level to really pay attention to and watch. A lot of times I'll have an exit on the books at that 100% level, and then I watch the momentum as it approaches it and then adjust accordingly to whether I want to take all of my gain off as it's approaching it, if I want to give it a little bit more room because momentum is picking up and I think it's going to go further. The next level that we usually hit past that is the 123.6 Fibonacci level. So you can see that up here in red. And then the really strong ones can go even further. So here's 138.2. And these are all just the core Fibonacci levels. So we're looking at 38.2, 50%, 61.8, 23.6. Not getting into anything too fancy right now. But here's another example of where we had an extreme move where it just blew past that 100% level. So here is ALGN, another recent one for you guys. This was another breakout strategy. I know some of you guys had this one on your radar over the last couple of weeks. It had based at highs earlier in the month, continued to have a nice little two-wave correction in here, shifted momentum, and then broke out really strongly with that breakaway gap here a couple of days ago. And you'll notice that the gap itself, it not only took it past the 100% extension on this breakout over here, but it doubled it. And we saw resistance instead hit at that 200% level. So what's interesting here is that even if you're in a trade late and you're still looking to play continuation of the momentum, the Fibonacci, these Fibonacci levels that go past some of the initial moves are still going to be very, very relevant, and they're going to continue to be relevant going forward. So even if, let's say, you missed this breakout that took place on the 26th, maybe you didn't want to hold it overnight into news, something like that, well, you're just looking to trade the gap strategies, so be it. The Fibonacci levels are still going to be important when it comes to understanding gap levels. Now, I rely a lot upon reading pure price action. In fact, most of the classes I teach have to deal with reading pure price action, where we're not using any indicators, not using Fibonacci, we're not using moving averages, RSI, stochastics, CSI, nothing. Because it's important to understand how to read pure price action in order to understand which of these additional indicators is really going to be a pro for your trading system and which of them is going to be a con. So when you're using and adding indicators back in to give you like additional visual cues, Fibonacci is one of them that I rely on, and I teach a lot of traders because it just works so incredibly well. And when we look at these levels, you'll notice that not only does the 200% level hit and hold very well on ALGN, but so does the 300% level. You can also say that these are based upon these measured moves, because indeed this move here, this impulse move here, then has an equal measured move when it hits the 300 level coming from the 200 level. So there is definitely overlap here in how they work out and how they play out. But a lot of these other levels are still going to hit and hold extremely well also. For example, the 76.4% level is a very, very common one where when momentum is shifting, it'll manage to make it to that 76.4. If you use FAN, 76.4 is a great level to look for as a breakout. So those other levels are also very, very important. Let's look at momentum now as it slows. Let's say that we have a breakout that is more gradual than the momentum we saw on the impulse move that took place earlier. So in this case, we have B is slower than A. It's a more gradual move. And it might still be the same type of momentum here as we see, on the pullback, on the correction, but it's slower than the previous impulse move. And that is what is important. So when B is more gradual than A, then it's going to be more difficult to put in an equal move. This is especially common at the end of a trend or in a counter move within a larger downtrend. So I talked about this a little bit earlier. If there were like 3 waves of buying over here already, then it becomes a lot more difficult if it tries to go for a 4th wave, and you're usually going to see it fall short of that measured move. So we can also use the Fibonacci levels now to identify target levels based upon that. I'm going to show you an example here. This is a trade from a number of years ago, and I'm pulling up this chart to show you how things can shift and how they change. So earlier, we were talking about Tesla and the momentum reversal on Tesla. Well, here's that same type of momentum reversal here. Momentum is shifting. And this is another breakout where we had a 2-wave breakout, really strong impulse move coming off of lows. But you'll notice even though momentum is kind of a little bit on the strong side to begin with, it's still slower than it was going into the congestion. And then it slowed even more by putting in these series of slightly higher highs. Usually, when you're looking for continuation type of moves, even though this broke out more gradually and it diminished the odds of getting an equal measured move and hitting that 100% target level, usually you're still going to have a chance at getting a second wave of buying that can bring it up a little bit closer. And you'll see, for example, a lot of times these initial moves will have two waves within the initial impulse move. So you'll often see two waves coming out of it. Well, when you don't see that happening, then you're going to be in trouble if you're on the long side. Because what can often happen then is that as the momentum shifts, if you see that telltale third high with the momentum shift here, this is where I will go ahead and usually bail on a position if I'm long already, because it is most likely to give me a really strong flush in the opposite direction. So if momentum is shifting and I now have this momentum reversal strategy, it tells me it's time to get out of this. You know what? It's not going to get to those larger target levels. And my chances of it getting to those larger target levels without having a really strong flush is going to be much higher. If I really, really, really love the larger time frames, I might take off part of a position, but I'm probably not, because the risk is just too high by that point. Now, we go to something a little bit more recent here, and you look at Facebook. This is a trade from earlier this year when I gave another version of this class. And you can see the same type of thing happened here as well. But what I want to show you again is we are looking at when this starts to fall into congestion. I'm not looking at this high to help me label where my extension levels are going to be. But you'll notice over here again, momentum is changing. Coming out of this breakout, we had a little bit of a slower move than compared to the gap. And then here's that second wave I told you about. So you'll usually get the first correction and then a second correction if the momentum is shifting. You'll get a second move rather. So that's usually a great place to start to expect that, okay, if momentum is slowing going into the second high, there's a good chance that that zone is going to hold pretty well. In this case, there was actually a third one where the momentum shifted even further and just provided even further confirmation that this is getting ready to turn over and give back a lot of those gains. And not only that, but it can do it in a really, really short period of time. So this rounding off and this shifting in momentum can lead to these strong reversals and actually trigger a reversal strategy, which brings us to, well, I'm going to show you guys Amazon here, and then I'm going to show you the trade that I took yesterday. Thought I had my slides turned around, so sorry about that. But here's another example. Same type of thing. Go to where the momentum starts to shift, not the absolute high, last low within it, and that gives you your extension. So here's that 76.4. Again, you'll notice it manages two waves. In this case, it kind of congests here, a little bit higher high, but it's really that second wave that matters. So when you're seeing that happening, it's just a key for a heads up that you're starting to get this risk coming in for these rapid retracements, these rapid reversals. So this happens a lot where you have a really extreme momentum move to kick it off to start with. So when you have like the stronger than average, much more extreme impulse move, you get this type of thing happening a lot where it'll try to break out, but it'll have a stunted breakout. And even if it continues to try, it'll still continue to falter. A lot of times when you have gaps in the morning, for example, you'll see an upside move in the morning that's really, really extremely strong. And then you'll see congestion going into the afternoon. And then when it tries to break out in the afternoon, it just can't really get momentum going right away. Maybe later on it manages to gain momentum again, but getting started, it has a really hard time. And a lot of times that's because you have an extreme move going into this. An extreme move meaning it puts in that impulse move in a much shorter period of time than it would typically do in the past. Maybe it does it in like 3 bars, for example. then this type of breakout type of action becomes more commonplace. So Fibonacci levels are still very, very helpful though when the momentum is starting to shift, because they can help you identify where those substantial levels of resistance are going to be that you can look to take your gains that are now going to be stunted because of that shift in momentum. So 50%, even the 38.2%, these are pretty good levels that will hold a lot. And one of the key things that you can watch for is when you start to see momentum shifting into one of these levels, then it's more likely to hold. So for example, there's the shift in momentum here between the 38.2% and the 50% extension. So that leads to a bit of a better correction, and it holds that 50% level. Over here, it goes pretty well into that 76.4, and momentum is actually pretty strong going into it, but you've got 3 waves going into it. So you've got some short-term trend exhaustion. So that's another way you can think of, okay, you know what, trend is playing a role in the impact this resistance is going to have. So it continues to test that level, but eventually it shifts momentum. And that allows, again, for this sharper correction. So there's a question here, do we read the Fibonacci numbers to the left or to the right? So here's the Fibonacci numbers, and you can put them on either side of your chart when you're drawing them. So there's the option of whether you want them placed on the right or the left. Every platform has a built-in standard that it will use, but you can change it. So you can put them on the left or you can put them on the right. It doesn't really matter. It just depends on, sometimes it might get messy if you're keeping it on the left, because it might overlap a lot of your price action over here. So that's why I usually keep it on the right. And I usually, on my charts, I have a blank space in here. So my charts end right here. Actually, I'll show you guys that. Oh, I don't have it on this one, but most of them, what I do is I have a little bit more space over here so that I can read the levels easier, and that just makes it cleaner for me. If you don't have a lot of screen space, though, that can that can impact your ability to do that. But yeah, there's no right or wrong way to do that. Okay, so this brings us to my trade from yesterday, last night actually. So here's another example of this, where we're looking at, there's a nice little breakout here. Yesterday, midday, nice solid move to the upside, but it's not able to continue the momentum as strongly. So it starts to shift here. And we begin to see that slowdown right as it hits 38.2. So this is something that's, again, really common. I said earlier, when momentum is stronger than average, when it hits 100%, then that expansion will start to stall at the 100% level, and you can see continuation moves past 100%, but they'll usually be slower. Well, the same thing can happen that can shift momentum, meaning that it can hit a level like the 38.2% level, especially if it corresponds to something like a previous high. And that can be the instigator for a shift in momentum. So something might be going strongly. You think, hey, no problem, this is going to hit that 100% level really easily. And then, bam, the momentum slows as soon as it hits that 38.2%. And 38.2% is one of those big ones. So that's one of those levels that you will take your cues from, is the 38.2%. Now here, you'll also notice this was a really extreme move to the upside. It was one of those examples where you had basically 3 to 4 bars, puts in an average impulse move in a very, very short period of time. So it makes it much further than you would see for a typical impulse move. This impulse move here, the continuation one, is actually more typical. And you can't see that without going back further in time, but this is an example that does show that. So when this offered the continuation, Usually, again, if momentum is shifting, 76.4 is a really good level to watch for with a momentum shift to look for taking gains. So the key ones I look at are going to be things like that 38.2, 50% you can also use, but it's a little bit more important when it comes to corrections. So you'll notice that when this pulled back, it held the 50% level really well. It does it again over here, as we'll see in a couple of minutes. And then 61.8% and 76.4% are those other two big ones. There are some other ones that people will use, but these are the ones that I rely on the most heavily, and I find that I don't really need to add anything else. So when we're looking at support and resistance levels, we're looking at zones. The harder something hits, the more give that zone can have. So for example here, when this comes into the 76.4, it's trying to increase momentum a little bit. It goes through it and we get a tail on the upside. But the reason we know that the 76.4% level is still the level that is holding is overall the body of these bars is still under that 76.4 level. And when it tests it more and more securely. So you can tell that that 76.4 is really what's holding this in. And as momentum slows, when you have a slower move into a resistance level, such as over here, it might not hit it exactly. It might fall just a little bit short. So this does eventually get to that 100% expansion, but it takes quite a while to do it, and it takes longer than a lot of traders might be willing to hold because they might not be able to be around to monitor the trade and see how it unfolds and shifts over time. So when momentum is shifting, you can decide, you know, do I want to be more aggressive with the trade? Do I want to go ahead and take most or all of the position off at one of these closer fib levels just because I know I can guarantee my gains going into those levels a little bit better? Or do I want to say maybe I was planning on holding everything for 100%? Maybe at this point I'm going to say, okay, you know what, I'm going to take off half of my trade or 3/4 of my trade and maybe just leave a little bit more on because it's trying to still show some decent momentum. So I still think, well, maybe it can go for some slightly higher highs. But you just have to be aware that when momentum's shifting, that means that it can easily lead to a period of correction before it will try the highs again. And that's really what's important. Are you willing to hold through corrections or are you not? So this trade on the pound dollar here was one that actually triggered a little bit later on. And it was based upon that resistance level that was taking place late last night. Here's another one where, again, the momentum is shifting. It's the continuation. Trend is getting more exhausted up here. We're actually dealing with more of a channel. So it's coming up back into this previous resistance from this previous high, and it's also corresponding again to that 38.2% level. So once again, 38.2% shifted the momentum here, and it served to stall the momentum here. So we have two waves up, hits it, it can't bust through that until it rests longer. Then it's able to go a little bit farther, hits the 50%, which is that same zone as that 100% based upon this one. So here's the trade, and I took a snapshot last night as I entered the trade so you guys can see the price and everything. And what you'll notice is that I took this trade based upon the momentum shift, and it was a variation of a momentum reversal. So I wasn't looking for a lot on this because we were dealing with strong upside overall here to begin with, but by paying attention to momentum and paying attention to the major resistance levels that were overhead, it still was able to yield a trade that returned over about 3.5 to 1 what my risk was. So here was the entry. Here's the stop above the high, which was that 100% expansion that we were just looking at. And then on a momentum reversal, typically a momentum reversal will look like this. It'll look like a parallelogram. You'll have that first channel coming off that first high. And the initial target level is where that channel breaks. So that's what you're seeing here. And that triggers the target level. So you'll actually see that when it came into this target, it started off really strong, coming off of that 100% expansion, but it started to shift momentum. And then it shifted it further, and it actually offered a trigger for a reversal in the early morning hours when I was already asleep by that time, missed it. But you know, you can see how these Fibonacci levels will serve as great support and resistance levels for these trades, because this low here, right at my target zone, was also that 50% level. Let me see if I have that on that next chart there for you. So here you go. You can see where, based upon that initial move, that support also helped with shifting the momentum to lead to a continuation. And as this continued into today, you can see that those same Fibonacci levels that were based way back here continue to serve as really good resistance levels going forward, even as this continued to play out into today's session. So you've got the 100% again in this zone here. You got the 123.6 and the 138.2. So they continue to serve as support and resistance throughout the day. And that's the funny thing about Fibonacci, is that a lot of times I'll go back to charts that I was trading like weeks ago or months ago, and I'll have Fibonacci lines drawn on them, and everything going forward will continue to bounce back and forth through those same levels that were based upon Fibonacci lines that I drew way back when, just because they're based upon some of the larger impulse moves that were on that particular time frame. So if this were a daily time frame, for example, then the same Fibonacci levels are going to continue to play out here. So what's next? You know, you learned a lot today about Fibonacci. Obviously, there's a lot more that you can still learn, especially when it comes to understanding trends development with momentum, looking at time development, which I mentioned today but didn't really get into, looking at how different support and resistance levels work together, different types of Fibonacci can work together, and how they all come together to create these strategies. In fact, you'll notice, you know, that trade that I took last night, I didn't use a cue for a confirmation like a break in a trend channel. I was in this before that channel even broke. So the boot camp that I'm offering right now deals with how to read pure price action so that you can make choices like that and not make incorrect choices. Why is it that I was able to get into this trade before it even technically quote unquote triggered, according to what a lot of people will use, and it worked out and hit the target level perfectly. I mean, this was the last trade that I took. I didn't trade this morning because I was teaching a class. So it was the very last trade I took, you guys, and nailed it. And this is something that you guys can do once you understand how to read pure price action and putting all of these together. So right now I have a boot camp going on. It's my market timing boot camp. It's the 5 technical signals you cannot trade without, but I've added another signal. So technically it's the 6 technical signals that you cannot trade without. And it is 14 hours of premium live training for $197. So you can learn more about this and register at tonihansen.com/timing. So what you're going to get in this boot camp is that over the last 4 weeks, we've had live classes and live sessions. So you can get the recordings to all 4 of those sessions so far. And about half of the people that are registered for the class aren't able to attend live, so they're just following through with the recordings. Thank you guys. Some of them, like I said, some of you guys here are in the class, and so you can follow through it with the recording and send me questions via email. So when you have questions and follow-up, you can do that. And we have 2 more classes coming up over the next 2 weeks. They are on Wednesday at 10 o'clock Eastern, and they last for 2 hours. We use a combination of PowerPoint and live market data and analysis. So we are looking at things that are happening live, as well as understanding how they happened over time. So the next 2 weeks coming up are going to be focusing upon putting all of the building blocks together. We're going to be looking at different strategies and pros and cons on those strategies, entry and exit techniques, and also looking at managing target levels. So one of the upcoming ones is next week is going to be looking at my core favorite strategies that I usually kind of ground my new students with and start with. And then we'll be looking at some advanced trade management, meaning once you're already in a position, okay, now what? You know, this session today was a really great preview of that. It's kind of like a short Cliff Notes beginner version of that. So we'll be getting into that in a lot more detail over the next couple of weeks. Right now you can access all 4 weeks from the Market Timing Bootcamp to date, as well as several great bonuses. So we've got the 2 more weeks of live training coming up, and we've got a copy of my Market Timing Playbook, which lays out all my strategies that I trade using pros and cons and how they relate to these 6 technical signals. And you can also get a copy of my 5 technical signals you cannot trade without book, which is several hundred pages that goes into substantial detail on every single one of the 5 technical signals that you cannot trade without. So this boot camp begins at 10 o'clock on Wednesday. So next Wednesday is the 8th. So if you get enrolled here today, you're going to have time to go through and watch all of those videos, catch up. Just in time for next week's session. We'll be meeting at 10 o'clock. I give people that first half hour of the market so you guys can take care of any trades that you might have going on, and we can watch for things that can be developing and give us some strategies to trade during the day that day. And yeah, so 2 hours, Wednesday the 8th, Wednesday the 15th, and you've got about, let's see, about 10 hours so far in video recordings. On Mountain Time, that is going to be 8 o'clock, 8 a.m. Again, if you cannot make it live, don't worry because everything is recorded. Right now, we're sending out the videos every week, and if you're just joining in, you get a copy of all the previous videos. At the end of the course, every single video is stored in a member section. So you can go back and review them as many times as you want, and they're going to be stored there indefinitely. So you'll have your own username, your own password. You can go back, you can study the manuscripts, and you can go back and study any of the video lessons. So if you guys have any questions at all, you can email me at info@tradingfrommainstreet.com. And I will answer any additional questions that you guys have for that. I know I'm running a little bit low on time here, so I just wanted to put out that email address for you in case I'm not able to take your questions here. Am I going to offer trade alerts too? Over the next couple of weeks, yeah, we will probably have some trades that trigger during those setups, during those sessions, but I trade a lot of different markets. So I trade futures, Forex, stocks. Hold on a second, I'm posting my name in here, or my email address, tradingfrommmainstreet.com. So you can see that in the questions I've just answered top us. And this boot camp is 197 for all of that. I know it's crazy low amount, but I took a little bit of a break over the last couple of years, so I offered this special to everybody coming back with teaching. So you can join me now. A lot of you guys are already in here. If you have any questions, info@tradingfrommmainstreet.com. I will be getting back to doing my trading room as well. I have some questions on that going forward. I ran a live trading room for about 12 years full-time, 15 years part-time. And by full-time, I meant like I was there at all crazy hours of the day. I kind of got a little burnt out, so I backed off on doing that and started working a lot with more individual traders, small group mentoring boot camps like this. So, you know, just getting back into doing that again. But I will be doing the trading room again. It'll be a part-time room, and that will be coming up here. It'll be get going before the beginning of next year. Let's see here. What cues do I take into account when determining how much or to what Fibonacci level it will go to before it turns? That's a great question. And that answer is in this boot camp. So there's other things that go into it. Obviously, the momentum that we looked at. When momentum is shifting, that's going to tell you that you need to be looking at some of those closer Fibonacci levels. You knew that. So you're going to be looking at some of those closer Fibonacci levels, but it's also going to be a matter of reading trend development as well. So for example, when you're looking at a breakout, let's say we've got this breakout coming out here, right? And maybe you see this pause and momentum is starting to shift here. You can tell that by transecting this trend here. And you're looking at, okay, well, can it get to another level? Well, this goes back to where trend development comes into play, because when you're looking at continuation moves out of like a breakout strategy, those often come in waves of two. So if you had two waves, even if this is just a little slight pause on this upside, you can usually count for two waves on the continuation. So if you have an initial move that hits like that 38.2 really easily and then it struggles and you see that pause, well, it might only get to that 50% point. So you can look at trend development as a measure of how to determine which level as well. You can even drop down, and if momentum is starting on this continuation that's just as strong here, you can look at, okay, which Fibonacci level is also going to correspond with resistance there. And you can look at synchronicity with the Fibonacci levels. We can add Fibonacci fans and get into some the retracement levels that are actually extensions past retracements. So those are other things that we can look at to help identify what levels are going to hold, which Fibonacci level is going to hold. Today we just talked about momentum and Fibonacci, but obviously there's more to it. And the next couple of weeks in the boot camp go into integrating these into a whole. So this is where we're going to be integrating them into the different strategies. Things like that market momentum reversal I talked about earlier, and things like the breakout strategy. According to my training, you are not Fibonacci and Elliott wave traditional. You are very interesting. No, absolutely, I am not traditional. I taught myself technical analysis, you guys. So I did not rely upon other books or courses to teach me about Elliott wave or to teach me about Fibonacci. I came from a background in art. I was actually an archaeologist before I got into trading. I'm still an artist. I still do portraits, so realistic art. I'm a realist when it comes to art and painting and drawing. And I used what I learned in those professions to teach myself the markets. So yeah, you know, I didn't even really know anything about Elliott wave whatsoever when I started trading. It wasn't something that was even in my my vocabulary whatsoever. It's just like, oh hey, you know what? Yeah, that corresponds to what Elliott wave is teaching, but here's what I do differently. So, you know, that's what I guess makes my style of market analysis stand out from what you might have seen from a lot of other traders. I'm not as rooted in some of the traditional systems. You're certainly going to see a lot of overlap just because, frankly, systems that work and have withstood the test of time, you're all going to notice overlap between those systems. My system relies upon learning to read price development and using indicators as secondary tools for confirmation to give you better visual indications for major levels, but they aren't going to be a predominant thing. And it's going to be the difference of teaching you why one bull flag works and another doesn't when you just look at a snapshot and they look exactly the same. And in reality, when you look at the bigger picture, there are some very big differences that make one strategy work and the other not. And that's how I got into understanding price development as well, is because I was looking at things like pullbacks into 20-period moving averages, and some were working and some were failing horribly, and others I just couldn't, the ones that were working, I couldn't get into fast enough. So it led to a lot of tweaking. 20 years worth of tweaking actually is what you're going to find in that boot camp, and hopefully it will take a lot of years off of your own learning. So head over to tonihansen.com/timing and you can get in on the boot camp and send me any questions you might have at info@tradingfrommainstreet.com. All right, so are there any questions? Looking at a winning method to trade the E-mini S&P. Is your way of trading profitable truly, and do you make your money or do you make your money teaching? So actually, no, I made most of my money trading, not teaching. In fact, you can ask anybody that has worked with me on the marketing side of things. I'm pretty horrible marketer. I tend to let my classes and my training and my teaching speak to themselves. So for the first time in 20 years, I actually hired a marketing company. So I'm working with the guys over at Trade Thirsty, just thanks to their reputation. So yeah, most of my money was made during trading and managing accounts over the years. So I've had a number of accounts that I've managed as well. Winning strategies for trading the E-mini S&P. Well, there's a couple of favorite strategies that I like. So like that momentum reversal that I showed you guys on that trade that I had on the pound here last night. That's one strategy, and I showed you guys a variation of that. That variation that I showed you is actually the one that has the least return. That one has a 90 to 98% profitability where it will hit that target level that I showed you 90 to 98% of the time. So if that's all you're looking for, that strategy, no matter how much of a variation you throw in there, is going to hit that level 90 to 90% of the time. Now there's also strategies where you can adjust it and it's going to hit substantially larger target levels when it's corresponding to a major trend reversal. So that one is one of my favorite ones. I like the 2T, which of course is that double top that is creating a trap. Another one that I like are two-wave corrections. That can mean something that is as simple as being the head off of what could be an inverse head and shoulders. So I'm looking to come off of that low, and then you can add into it or trade it further coming off of the next shoulder. A lot of times with that strategy, I'm building into a position, so I'll get into a part of the position here and then get into more of the position as it's forming that first correction or first pullback. So those are two additional strategies that I love. This one over here is called the Phoenix, which is a name that I came up with years ago when, again, I didn't know a lot of the names for traditional strategies, and what I found out was that, okay, my Phoenix overlapped with what a lot of other traders were using, but maybe some of them just didn't even have names for, like something that was coming off of an absolute high. And then they'd see this pullback. Well, it's not an uptrend yet, really, so it's not a bull flag. It doesn't have a higher low before it triggers, that is. So that first correction basically is what I call a Phoenix. So that's one of my favorite strategies. The inverse, the flip side is the avalanche. It can be part of an inverse head and shoulders like you see here. It can be part of a cup with handle where it's the handle. But in either case, it's that first correction. For how long can you access your training? Indefinitely, as long as the As long as the member section is up, it will be available. I will guarantee at least 2 years. I have courses on there that have been on there for 10 years that people still have access to, actually. Are these strategies in the e-mini package, this training package? I'm not sure what that is referring to. So I don't have an e-mini package per se. I've taught boot camps that are focused on trading just futures market, but this one deals with all markets and all time frames. So we're not just looking at futures, we're not just looking at Forex, we're not just looking at stocks. These are going to be things that you can take and apply to any market and any time frame. So I first began trading in the mid-90s as a stock trader, as a swing trader, and that merged into doing futures trading because I was invited to participate in a trading room, and they liked the calls, they liked what I was doing, they liked the live training that I was doing. They had me branch off and do my own trading room, and so we were following, futures markets a lot, and so that got me into trading futures as well. And then, going forward, branched off, added Forex, and, it's kind of kept going from there. So everything that I learned in trading stocks is what I've applied to trading futures, is what I've applied to trading Forex, trading bonds, gold. So all of those markets now, oil, all of those, doesn't really matter, really. The strategies I was discussing are in the training package you offer. Yes. So the market timing playbook that you see here, this goes into many of the strategies. So it has, actually, I might be able to pull up an image here, guys. Hold on just a second. I'll show you. Let's see. I'll show you an example of what those looks like. Okay, so here's an example that's coming from that playbook. So one of them is looking at, for example, the 2T. So when we look at, let's see here, the strategies, it'll go through looking at pros and cons, which are my building blocks of price development, which are what the entire bootcamp focuses upon. So we look at things like pace and momentum. We look at trend placement, trend development, support and resistance levels, volume, correction periods. Also, a new building block that I've added over the last couple of years is time development. And that means, like, how long does it take for a strategy to form and to develop? And that is incredibly important as well. And it's become one of the top 3 most important things to look at. So momentum, trend placement, and time development are the 3 biggies. And then, of course, you've got the additional support and resistance, volume, correction period. Support and resistance can include things like the Fibonacci levels. And then it takes the strategy and shows you actual trade examples involving those strategies, and it shows you pros and cons that were based upon them. So not every strategy is perfect. There's always going to be cons on every strategy. So it goes into looking at the different cons that were involved as well. So that is, just a couple of the pages out of that book. That book itself is, I think, about 200 pages. And then the other one that is included in the boot camp is my 5 technical signals course, 5 technical signals book, and let me see if I can pull that up here and show you guys. So that one, when printed, is over 400 pages. And let me grab a copy. So this goes into a lot more. So we have, let's see here. So it goes into a lot of the advancements with understanding momentum. There's, at the end of each section, there's also worksheets for you guys to practice on and to test your knowledge of what you learned in each of the sections of the book. So the printed book, when it's in typical print format, is over 400 pages, but you can condense it like I've done here. So we've got 250 condensed. But it goes into all of these topics. So we've got volume, understanding spreads, accumulation, news and volume, distribution, exhaustion, volatility, slippage, holiday trading. You've got monthly correction periods. We've got understanding gaps and gap trading. Some introductions to Fibonacci, understanding trend development, and risk management, and assessing market conditions, and again goes into more gaps. So all of that is covered in this book. So you'll get a copy of that book, a copy of the market timing playbook, and then of course you'll get all of that live education as well. So here's the link again for the boot camp. So it's tonihansen.com/timing. And let me go through some of the questions again here. Does my little guy trade yet? Yeah, the little guy you saw on the screen, not yet. He is 6. We are kind of teaching him, but he's not that interested quite yet. I'll convert him though. He just give me a little bit of time. His dad's trying to get him into engineering. Let's see. I'm just scrolling through here, make sure I get all the questions. I followed a few good traders, and there seems to be an evolution of trading stocks, then to option spreads, then to futures. Why is that? I think a lot of it has to do with changes in regulation over the years. Okay, so, you know, first when we were trading stocks, you could start with smaller accounts. Granted, commissions were horrible. You'd get killed. I mean, my first months of trading, I lost 20% of my account, but it was all commissions. I mean, literally, it took you $40 to get into a trade and then another $40 to get out. You were dealing with massive, you were down $80 before the security moved at all. So obviously trying to trade small, you didn't have much luck being able to do that. You were going to lose. It was basically a learning. And they didn't have all of these simulated trading accounts that you have these days. You just can't do that. So obviously, you know, that was part of the shift. Going into options, people were able to better manage their risk and keep their prices down better. So, you know, that was something that attracted a lot of traders. And, you know, in order to trade stocks, especially if you're getting into day trading, you've got to have at least $50,000. And for a lot of newer traders, that really isn't an option. Whereas with futures traders and Forex, you can do that. I mean, you can open smaller accounts and make the money easier. So I think that's where some of that came from. You know, stock trading is not as popular just trading pure stocks for that reason, because you do have these other avenues to go to. So I think that's probably where you've seen that transition. I know a lot of traders, especially that just trade stocks, they've switched to trading options, and a lot of them will specialize in certain options, certain securities, for example. Even stock traders like to specialize in certain stocks. I tend to focus on things that are trading over 500,000 average shares a day. Sometimes I'll go under if I'm looking at swing trades. I don't generally limit myself. You know, what I might trade one day might be completely different from what I trade next week. So I might trade all Forex for one week just because I'm on a Forex kick, and then the next week I'm trading more stocks. So I like to go back and forth, just shift as the market shifts, basically. There's no right or wrong market to trade. There's just whatever market works best for you. You thought it might have something to do with the way markets trend. So stocks come in and out of favor. The same thing can happen with different futures markets as well. So certain things will be trending really well at certain periods, and then they just won't trend as well. So that's why stocks come in and out of favor too. So yeah, you know, that's definitely part of it. But I don't think, you know, that's the whole reason. I just think that they found that they can get better returns compared to what they're risking by trading those markets. And also, if you're dealing with a lot of traders that happen to be mentors as well, the switch could also be in part because newer traders have easier chance getting started in those markets. So getting started in options and futures and Forex is a more cost-effective way for a lot of traders than diving straight into stocks these days. So you could be seeing that shift just because that's where the educational side of things has shifted to as well. It might not necessarily be that all these traders have totally shifted. It could just be that traders that are teaching have shifted. All right, everyone. I'm going to, now I think I've got my timing correct. So yes, the Fibonacci, the course does talk about how the trend development integrates into Fibonacci development. So it's, you know, all encompassing. So yeah, next couple weeks we'll be integrating all those systems together. So I hope to see more of you guys there live, and that will be next Wednesday at 10 o'clock. So thanks again, Dan. Sorry about the little timing mix-up here a little bit earlier, but again, Bob Lang is up next, so stick around and you will hear him.